Hey everyone, welcome back to the channel. Today, we're diving into something that can take your trading game to the next level, smart money concepts, or SMC for short. Now, if you've been around the trading world for a while, you've probably heard about price action trading. But what if I told you there's a more sophisticated way to approach it, one that aligns you with where the big players, like hedge funds and institutions, are placing their orders? That's exactly what Smart Money Concepts is all about. In this video, I'm going to break down everything you need to know about SMC. We'll explore how it works, why it's such a powerful strategy, and even get into some trading strategies that you can start using right away. In this video, we're going to dive deep into some key concepts of smart money trading. We'll cover order blocks, break of structure and change of character, equal high/equal low premium and discount zones, fair value gaps, liquidity grabs. And most importantly, I'll share a secret with you, how to identify all of these with just one click. You don't want to miss this. Alright, let's talk about one of the most crucial elements in smart money concepts, order blocks. So, what exactly are order blocks? Well, these are areas where institutions, like banks and hedge funds, are most likely placing their orders. Knowing where the big players are setting up their trades can give you a serious edge. To spot an order block, look for areas where the market is consolidating. This usually occurs in zones with high volume, meaning the price is likely to return to these levels. Sometimes, these blocks form due to imbalances in the market. Pretty cool, right? Now, check out this image. Here, you can see how order blocks are formed right after a ranging market has been broken. This is super important because it shows how order blocks differ from typical support and resistance zones. They're much more precise and tied to institutional activity. So, when you're analyzing the charts, keep an eye out for these order blocks. They can be a game changer in your trading strategy. In smart money concepts, break of structure, BOS, and change of character, CHoCH. These concepts are crucial for understanding market trends and making informed trading decisions. Let's break it down. Supports and resistances are fundamental in price action trading, but they play a significant role in smart money concepts as well. The primary difference is how we interpret these supports and resistances. In smart money concepts, we analyze them when the price breaks through these levels. Take a look at this graph I created. A break of structure, or BOS, occurs when the price breaks the most recent support or resistance in the direction of the trend, whether bullish or bearish. For instance, if the trend is bullish, we expect the price to break resistances rather than supports. On the other hand, a change of character, or CHoCH, happens when the price breaks the most recent support or resistance in the opposite direction of the prevailing trend. In this example, we can see that while the trend was bullish, the price eventually broke support, indicating a potential shift. This shift is significant because it could signal a trend reversal. The term break of structure comes from the fact that the price continues in its new direction after overcoming obstacles. If the obstacle is substantial enough to break the support or resistance while still maintaining the trend, we label it as a change of character, or CHoCH. Now, let's look at another graph to see how to trade BOS and CHoCH effectively. This chart shows various breakthroughs of structure and changes of character. Notice how the indicator marks significant BOS and CHoCH with a straight line, indicating higher accuracy. The key here is to focus on these major BOS and CHoCH signals marked by straight lines. When a BOS or CHoCH label appears, you should enter a trade after the price retests the broken resistance or support. For a long position, buy when the retesting candle closes without a significant volume increase. For a short position, short after the BOS/CHoCH label when the retesting candle closes with similar volume characteristics. By focusing on these major signals and understanding their implications, you can make more informed trading decisions and potentially capitalize on trend reversals. Equal highs, EQH, and equal lows, EQL. These are essentially the smart money concepts equivalents of the traditional double tops and bottoms you might be familiar with in price action trading. Let's explore what they mean and how you can use them. In traditional price action trading, double tops and bottoms are well-known chart patterns that indicate potential reversals. In smart money concepts, these patterns are referred to as equal highs, EQH, and equal lows, EQL. Let's take a look at an example. Here's a graph showing an equal high, EQH, pattern. As you can see, the price forms a double top after an uptrend. This pattern indicates that the price has reached the same high point twice. The crucial level here is the support line, which is the neckline of the double top. After forming this EQH, there's a chance the price could break through this support line, leading to a change of character, CHoCH, which indeed happens in this example. However, keep in mind that while EQH and EQL patterns can be useful, they don't always lead to significant price movements. I personally use EQH and EQL primarily to identify strong support and resistance levels, rather than relying on them alone for trading decisions. They can also be helpful for spotting potential trend reversals, especially in major support and resistance areas. To get the most out of EQH and EQL, it's best to use them in conjunction with other smart money concepts tools, like order blocks and break of structure, BOS. Combining these tools can provide a more comprehensive view of the market and enhance your trading strategy. We're exploring an essential concept in market analysis: premium and discount zones. Understanding these zones can give you a strategic edge in your trading. Let's break down what they are and how to use them effectively. Premium and discount zones are key areas that form in the market once a major support and resistance level has been established. These zones are crucial for determining potential entry and exit points. Take a look at this example. The premium and discount zones are highlighted based on the major support and resistance levels. The equilibrium zone, which is the 50% line on the Fibonacci retracement tool, is where the market often finds balance. As you can see, the price moves within these zones after establishing the major support and resistance. The equilibrium zone, located at the 50% Fibonacci level, often acts as a point where the price might reverse or consolidate. Here's another example showing the equilibrium zone in action. Notice how the price reacts around this area. It was ranging for a while before making further moves. This reaction can be a crucial signal for traders. For a practical trading strategy, monitor the price as it reaches the premium or discount zones. If you notice that the market's volume starts to decrease, this could be an indication to enter a trade. Set your take profit level at the equilibrium zone. The reason for setting your take profit at the equilibrium zone is that the price might experience a reversal or resistance at this level. By targeting this zone, you position yourself to take advantage of potential price reactions. To sum up, understanding and utilizing premium and discount zones can enhance your trading strategy by identifying key entry and exit points. Always combine this analysis with other tools and market conditions to improve your trading accuracy. Fair value gaps. These gaps are critical for identifying potential support and resistance areas. Let's break down what fair value gaps are and how you can use them in your trading strategy. Fair value gaps are imbalances in the market that often act as significant support or resistance levels. They typically form during periods of high volatility, such as when there's a breakout or retest. These gaps are characterized by a large candle body. Take a look at this example. We can identify a fair value gap by observing the size of the candle body. To pinpoint the gap, follow these steps. 1. Look for a large candle body, like the one shown in the chart. 2. Draw a rectangle with its base at the highest point of the previous candle's upper wick. 3. set the top of the rectangle at the lowest point of the following candle's lower wick. 4. Extend the rectangle to the right to mark the fair value gap. Here's how it looks when we draw the rectangle. The area within this rectangle is our fair value gap. This gap represents an imbalance in the market, often indicating potential future support or resistance. Fair value gaps are particularly useful for identifying key levels where the price might reverse or consolidate. By marking these gaps on your chart, you can better anticipate where the market might react based on previous imbalances. For a trading strategy, look for the line in the middle which is shown in the fair value gap. This line acts as a support, and the price can bounce off of it. For an entry point, wait for the price to react to the fair value gap, and, if the volume decreases while the reaction is happening, enter. Trading that often goes unnoticed, liquidity grabs. These are tactics used by larger market players to manipulate prices, and understanding them can give you a significant edge. Let's break down what liquidity grabs are and how you can identify and trade around them. Liquidity grabs occur when large market players, like hedge funds or whales, manipulate the market to trigger stop losses and create panic among traders. This manipulation often happens around key support or resistance levels where many traders place their stop losses. Here's an example of a liquidity grab. Notice how the price suddenly moves significantly, either up or down, around a support or resistance level. This move is often a trap to force traders into panic buying or selling. In a ranging market, a sudden increase or decrease in price can indicate a liquidity grab. This is a tactic to shake out retail traders who have their stop losses set at predictable levels. Here's another example. The sudden spike in price is a classic sign of market manipulation. This spike is designed to create a false breakout or breakdown, which can trick traders into making hasty decisions. For your trading strategy, here's what you should do. 1. Wait for the scam move. Monitor the market for sudden pumps or dumps that might be indicative of a liquidity grab. 2. Look for stagnation. Once you spot a manipulation move, wait for the price action to stabilize or stagnate. 3. Enter opposite of the move. Enter your trade in the opposite direction of the initial scam move. This approach can help you capitalize on the market correction after the manipulation. In this example, you can see how waiting for the price to stabilize before entering a trade can help you avoid falling into the trap set by large market players. In conclusion, understanding liquidity grabs can be a game changer for your trading strategy. By recognizing these manipulative moves and adjusting your approach accordingly, you can better navigate the market's complexities. Now we have understood the key concepts of smart money trading. What we have covered: order blocks, break of structure and change of character, CHoCH, equal high, EQH, and equal low, EQL, premium and discount zones, fair value gaps, liquidity grabs. No more wait. It's time to reveal the secret indicator, which is composed of all above levels of smart money concept. 1. Go to tradingview.com. 2. Click indicators. 3. Search for you can add the smart money concepts Luxalgo. And boom. If you found this video valuable, please give it a thumbs up and leave a comment with your thoughts or questions. Your feedback helps us create better content. Thanks for watching, and I'll see you in the next video.